Everybody, in this video we're talking about balanced budgets, which means we're going to talk about the spending multiplier, the tax multiplier, fiscal policy, balanced budgets in general. We're going to talk about so much to help you out with your macroeconomics learning, so I hope this is a valuable video for you. Now, with that said, let's get to it, okay? First of all, what is a balanced budget, okay? A balanced budget is a situation that the tax revenues going into the government, so that money that's going into the government is equal to the total amount of money that is going out of the government, okay? So that is a balanced budget. Again, the tax revenue equals the total amount of money going out of the government. Now, if the tax revenues were more than the money going out of the government, so tax revenues were more than the money going out of the government, you'd be running a surplus. If the tax revenues were less than the amount of money going out of the government, okay, that'd be a situation you're running a deficit. So a balanced budget is a situation that you're not running a surplus or a deficit. Now, I do want you to understand there's this thing called primary deficits, okay, that I'm not going to get into, so there's a little complexity I'm going to ignore. So I'm being kind of conceptual here, okay? Just generally speaking, balanced budgets, tax revenues, the money going into the government as taxes equals the total amount of money coming out of the government, okay? So that is a balanced budget. Now, what's interesting about the balanced budget multiplier is it actually doesn't matter whether or not the government's running a balanced budget or not. The balanced budget multiplier is actually not about the current state of the government's budget. It's about the changes the government is making to their budget, okay? So the balanced budget multiplier comes into play, again, when the government is making changes to their budget, what we would call doing fiscal policy, okay? So what am I saying here? I'm saying that the balanced budget multiplier comes into play for a situation like the following. When they increase government purchases, say by $100 billion, so again, increase government purchases by $100 billion, and at the same time, increase taxes by $100 billion. That is when the balanced budget multiplier comes into play. When they make a change to both sides of the government budget by the same amount. So again, it could be a situation, yes, where they would lower government purchases and lower taxes by the same amount. But more often, it's going to come into play when they increase government purchases by some amount, I'm going to say $100 billion in this video, and at the same exact time, they increase taxes by $100 billion. Now, here's the interesting thing that I hope students kind of understand right from the beginning, is if they increase government purchases, that is expansionary fiscal policy. They're doing that to stimulate, to expand the economy. When you increase taxes, that's actually contractionary fiscal policy. That is done to contract the economy. So what's interesting about the balanced budget multiplier, when we talk about the balanced budget multiplier, is the government is doing both expansionary and contractionary policies at the same time. They're keeping their budget in balance, if it was in balance, which again doesn't really come into play. It's just really they're doing a change to their budget of the same size, increasing the government purchases, those outflows from the government, and they're increasing the taxes by the same amount, the inflows to the government. So, in that situation, what is going to be the impact on the economy? That's what the balanced budget multiplier is all about. Again, just to make sure that you're with me, we're focusing on changes to both sides of the government's budget, the outflows and the inflows, okay? And again, one more time, in this video, we're going to increase government purchases by $100 billion, increase taxes by $100 billion, and see the impact on the economy. So, let's come to our circular flow, okay? Always we want to see the main circle of the circular flow economy, and the circular flow economy is very important. Circular flow economy teaches us that when we spend money, spending turns into income, which then turns into additional rounds of spending, okay? So spending turns into income, which turns into additional rounds of spending. The main components of our circular flow economy are the product market, the resource market, factor market, okay? I can change that to an R, so that works, factor market, okay? I generally go with the resource market, okay? They're one and the same. The resource market is the factor market. Why do I like to go with the resource market? Because that's the financial market. But again, the main circle of the circular flow model, product market, resource market, businesses, households, okay? That's the main circle, okay? Now, we also have the financial market and the government on our board because those are going to be very important for what we're trying to do in this video. Now, in this situation, the government was doing some amount of government purchases, okay? And what we're going to have the government do is increase their government purchases by $100 billion. Okay, so we're really focusing on that increase in the government purchases, again, by $100 billion. That is expansionary fiscal policy. We're pushing more money into the main circle. We're trying to increase spending. Increasing spending should increase production and increase hiring. Those are expansionary policies. At the same time, okay, we've got households paying taxes. Okay, so households, they're paying taxes. We're going to increase the taxes by the same exact amount, by $100 billion. Okay, so we're going to increase our taxes by $100 billion. We want to know, well, what is going to be the impact on the economy of these two actions? Again, expansionary, contractionary fiscal policies. We're doing both at the same time. Well, it has to do with the fact that the government purchases is a direct impact to spending, okay? It's directly changing spending by $100 billion. Spending is going to go up by $100 billion when we increase government purchases by $100 billion because, as I like to say, government purchases is a type of spending, okay? There's four types of spending: consumption, investment, government purchases, and export expenditures. And government purchases is one of those types of spending. So if we increase by $100 billion, spending is going to go up by $100 billion. Another way to say it is our round one impact of this increase in government purchases is $100 billion. That would be our round one impact, our impact to spending. Now, taxes are different, okay? Tax changes happen before the fork in the road, okay? So if we increase taxes by $100 billion, disposable income, okay, disposable income, which divides up into savings and consumption, disposable income is going to go down by $100 billion. Now, that does not mean that we're going to cut spending by $100 billion. No, we need to understand that that's going to impact both savings and spending, okay? The amount that's going to impact savings is told to us by the MPS, marginal propensity to save. Sometimes it's good to make that P percentage, so marginal percentage that goes to savings. Marginal what? Marginal meaning additional. Additional what? Additional disposable income, so additional dollar of disposable income. What is our percentage that's going to go to savings? We also have a marginal propensity to consume, okay? Of that additional dollar in disposable income, what percentage is going to go to consumption, okay? So here I'm going to say this is 0.2. You could also say 20%, okay? And here we'll say 0.8, which would be 80%. And yes, these two have to equal 1, or if you talk about them in percentages terms, they need to equal 100%. So again, 0.2 or 20%, 0.8 or 80%. So what does this mean? Our income goes down by $100 billion. We're not going to cut our spending by the full $100 billion. We're actually going to reduce our savings by a percentage of that, okay? So what percentage? Well, 20%. So our savings is going to go down by $20 billion. So we're going to cut initially, okay, in this first round impact, again, still in round one, okay? I know that could be confusing. I've already done the government purchases. The government purchase round one impact was $100 billion. Right now, I'm on the tax change. So forget about this for right now. I'm on the tax change, and I'm doing the round one impact of just the tax change. Okay, so again, disposable income goes down by $100 billion. Savings is going to go down by $20 billion, which means consumption is going to go down by $80 billion, and that is the round one impact of the change in taxes. So let me say that again. We're going to see a reduction of $80 billion, okay, a reduction of $80 billion in spending as our round one impact of that change in taxes. So again, that wasn't hard to do, okay? We raised taxes by $100 billion. I think it's very common sense to say disposable income is going to go down by $100 billion, okay? If we take $100 billion more, disposable income goes down by $100 billion. How do households react? They don't cut their spending by the full $100 billion. It's going to impact both their savings and their spending, okay? The fork in the road, okay? Change in disposable impact both savings and consumption, and the amount that changes in those things affect savings and consumption is given by the MPS and the MPC. So again, raise taxes by $100 billion, disposable income goes down by $100 billion, and since the MPC is 0.8 or 80%, we have 80% of $100 billion, which is $80 billion. That's going to be our reduction in spending. That's our round one impact. So what we should see as students, okay, is that the tax change is going to reduce our spending initially, the round one impact, our initial change in spending by $80 billion. The government purchase is going to increase our spending by $100 billion. So big takeaway, government purchases have a direct impact on the economy or spending. Taxes have this kind of more like indirect, okay? And so they don't have as big of an impact as the government purchase change. Yes, the government purchase and the tax change were the same size, but the impact on spending is different, okay? Again, government purchases, direct impact on the product market. Tax changes change disposable income, and disposable income divides up into savings and consumption. Okay, now, many ways to answer this question from here, okay? The way that I might answer this question is say, what is my net impact to spending? Well, that's pretty easy. It's $20 billion. So if I net out my two first round impacts, again, this one from government purchases, this one from taxes, it nets out to a positive $20 billion increase in spending. Well, our spending multiplier is 1 over the MPS. You might see it as 1 over 1 minus MPC. But again, that's the same as 1 over MPS. Let me say that again, since I kind of messed up on that a little bit. A lot of people might teach it as 1 over 1 minus the MPC. That's the spending multiplier. I like to think of it as this way. Understand that 1 minus the MPC is the MPS. So these two things are one and the same. Okay, so that's our spending multiplier. Okay, well, that equals 1 over, there it is, 0.2, which equals 5, which we like to say here at Econ Busters is a ratio, okay? Here's my initial change in spending. So every $1 initial or round one change in spending, I'm going to have a change on nominal GDP of $5. I'm going to have a $5 total change in spending, which I'll talk a little bit more in just a second, okay? So initial, for every $1 initial change, I get a $5 total change in spending or $5 total change in nominal GDP. Again, my net impact to spending round one was $20 billion. So I can easily just go, okay, my initial or round one impact was a positive $20 billion, okay? Well, if I solve this out, there it is, $100 billion. My total impact on the economy of increasing government purchases and taxes by $100 billion is $100 billion, okay? That is one way to solve that. Now I want to talk about why did the 20 billion become 100 billion, okay? Well, these two again net out to 20 billion, that's what's right there. And then that 20 billion, we can think of it going around and some leaking out and some more getting spent, going around, some leaking out, some more getting spent. We could think of it that way, that 20 billion is now going to make these trips around the circular flow again and again with a little bit leaking out as savings each time. Okay, here's another way that we could go about answering this question, okay? We could simply use the spending multiplier and the tax multiplier. So our initial change in spending was $100 billion, okay? Remember, our spending multiplier was 5 over 1. Our initial change in spending from the government purchase was $100 billion. So our total change in spending or total change in nominal GDP from the government purchase would be $500 billion, okay? Now, the tax change, okay? The tax change, what it did is we raised taxes, okay? Now, this is one of the very few times I'm going to use the tax multiplier. I don't like the tax multiplier, but I'm going to use it for just a second, okay? Just so that you can see it. So we raised taxes by $100 billion. So I'm going to put, hey, we had this positive increase in taxes by $100 billion. The times, okay, the tax multiplier. Well, the tax multiplier is a negative MPC over the MPS, okay? That's what the tax multiplier is. So let's go put that right over here. The MPC is 0.8, so I've got, well, let me do it right here, okay? 0.8, negative 0.8 over 0.2, okay? Well, we can do that, okay? That comes out to a negative 4, okay? So positive increase in taxes, $100 billion, times a negative 4. Yes, that's what the tax multiplier would be. And what does that give? That gives a negative 400 billion. Okay, let's net out the negative $400 billion impact of the change in taxes against the positive $500 billion impact of the change in government purchases. And what do we get? Positive $100 billion. Have we seen that before? Yes, that was what we got before when we just said the net change in spending was $20 billion. Same answer that we got before. another way to solve it, okay? The next way I'm going to solve it is pretty much what I just did. I'm going to do the government purchase impact. We've already got it, right? The government purchase impact is going to change total spending, which means nominal GDP by $500 billion. But this time, I'm going to use the spending multiplier with my tax change, okay? Don't worry, it's not going to be hard. Increase this by $100 billion. Disposable income goes down by $100 billion. We reduce spending by what? $80 billion. That's my round one impact. So I can just use the spending multiplier again. 1, okay, equals a negative, okay, $80 billion. Where'd that $80 billion come from? Right there. That's the round one impact. What's going to be my total impact? Well, if I solve this, I will get a negative $400 billion, okay? Of course, the negatives are going to cancel out. What was this again? This was the spending multiplier. I'm just using the spending multiplier for the tax change by just looking at the spending change, the spending impact of the tax change. So I just take the tax change, find out the change in spending, and I use my spending multiplier. Again, positive 500, negative 400, net amount, the impact on the economy is what? A positive 100 billion. I get the same answer again. And now finally, here it comes. The balanced budget multiplier. What is the balanced budget multiplier? It is 1. If you paid close attention, you may have seen the spending multiplier was 5. The tax multiplier was a negative 4. Well, 5 minus 4 equals what? 1. And this is going to be the case no matter what, okay? If you don't know what I'm saying right now, let's imagine just for a second, okay, just for a second, that this was 0.25, which would make that 0.75. So if that was 0.25, that'd be 0.75, okay? Well, what would be the spending multiplier? It'd be 1 over 0.25, which is 4, okay? There's my spending multiplier. What would be my tax multiplier, okay? Well, this would be 0.25. This would be what? 75. What does that come out to? A negative 3, okay? So 4 minus 3, what do we get again? 1. What am I saying? The balanced budget multiplier is 1. It will always be 1. Doesn't even matter what these are. The balanced budget multiplier will always be 1. Okay, so what does that mean? It means that if we increase government purchases by $100 billion and increase taxes at the same time by $100 billion, you just take that $100 billion change to both sides, okay, both sides of your government's budget. You take that $100 billion change, and you just multiply it by 1, and you find out your total impact on GDP, which is $100 billion. Hey, why didn't y'all just tell me right from the beginning it was 1, and just let us memorize that? Because we don't want to memorize things. We want to understand why it is 1. We want to understand why it's $100 billion. So I wanted to answer this question in multiple ways so that you can practice the spending multiplier, the tax multiplier. Using the spending multiplier for tax changes, which is what we teach here at Econ Busters, is just use the spending multiplier for a tax change. In other words, when you change taxes, just find out your change to spending and use the spending multiplier. Don't even need the tax multiplier. Anyhow, we wanted to do this in many different ways. But again, what is the balanced budget multiplier? It's 1. And by the way, if we lower government purchases by $100 billion and lower taxes by $100 billion, we put a negative $100 billion, and our total impact on the economy would be a negative $100 billion. Okay? Anyhow, I hope that made sense to you. Fiscal policy. We've got these levers of fiscal policy. Our levers are taxes, government purchases, and transfer payments. In this video, we just talked about taxes and government purchases, okay? We've got a balanced budget. Hopefully you understand what that is. We've got a spending multiplier and a tax multiplier, and yes, a balanced budget multiplier, but they're all related. Anyhow, I hope that made sense to you, and I hope to see you in the next video.